example, doing hedging. Because if you're simply entering a long, if you're wrong, you will lose as much as you will gain. Or if price goes up, the price goes down, you will lose and gain equally as much. What you're trying to achieve by hedging is, if you are wrong, you're not going to lose as much. And if you're right, you're going to be able to capitalize to a greater on that to a greater extent than you are going to be losing in case you are wrong. So that's sort of the basic explanation of hedging. You're trying to protect yourself and protect your assets. So basically, just risk management to reduce the risk of loss, basically. So the simplest way to do this, I'll just go on a random Bitcoin chart. The simplest way to do this is by buying and selling, sort of longing or shorting, longing and shorting the asset at the exact same time. That is essentially a hedge, because if price goes down, you will, let's say you were to long and short at CMP. If price goes up, you will lose money on your short, but that will be compensated by your long. If price goes down, you'll be losing money on your long, but all that money will be recovered with the short. So that's sort of the super basic way of hedging. But in this case, if you were to enter this hedge, you wouldn't make any money. You would be completely break even, and that's obviously not what we're looking for. I'm just going to make this the same color here. We're obviously not trying to be break even. We're trying to make money and reduce our losses. And the way you can do this is hedge at times where you can judge essentially the probability of either your short or long happening or working out, basically. So let's say this support resistance level here. Considering we are in an uptrend, support tends to hold stronger than resistance. And considering this is support, this is expected to be held, right? The chance of this holding is slightly higher than the chance of this breaking, right? Therefore, entering a hedge at this level, where the probability isn't 50-50, and for example here, on a simplistic way, considering we are sitting in no man's land, the probability that price goes up and down is literally 50-50. But at key levels, we believe that it's not 50-50. That there is some statistical advantage to longing or shorting off these levels. If you don't believe in the efficient market hypothesis, we believe that there is some statistical advantage or discrepancy at key levels, and therefore hedging off them makes sense. Okay. So considering we are expecting this to go up rather than break, so this drawing here is a high probability event, and this here is a low probability event. Okay. So what we're trying to do is hedge against the low probability event. Okay. So the chance of us breaking is low, but it could happen, right? And if it does happen, any long you do here will get fucked up, right? And you don't want that. So even though us breaking this support here is a low probability event, it could happen, right? Happens all the time. Happened here, happened with these wicks here, etc. Happens all the time, right? So that's sort of what we're trying to hedge against. So even though our main idea is to long down here, we could actually break this resistance, and therefore shorting support here could be a hedge, because the highest likelihood of what happens is we just hold this. But if we break it, your long will be fucked up, but that will be compensated by your hedge short, right? So just as a example here, what we could do is say this was your hedge, right? If price if you're betting that okay, price most likely won't break here or won't close below. If you go down, we can solve it for a brief period and then go back up. In this instance, if you have, let's say, formed some sort of support resistance here, and you flip this, you have quite successfully decided that okay, we probably won't break below, and therefore you would close your hedge short in a small loss. So this here would be in a small loss, of course, but you have protected yourself in case prices did dump, right? This would have been you would have protected yourself, right? So in cases like these, you would exit the short in a small loss, but considering we didn't close below here, we held this as support. We're expected to continue traveling upwards, which helps your long, right? So this would give you a slightly smaller profit. But as an example, let's say this did happen. Let's say like that. There we go. Let's say this low probability event did happen. We did break through. If your hedge wasn't there, you would have hit stop loss, maybe lost 5k, 10k, whatever. But instead of that happening, this hedge compensates for that loss, so you actually go somewhat break even. Alright. So that's sort of the beauty of this. You can hedge against low probability events, and as soon as that event is sort of ruled out that won't happen, you can close your hedge and ride off your initial idea. Explain to the people how to hedge the USD and make more Bitcoin. What? Gold versus DMX index, crypto and Bitcoin. What? So it's like sacrificing some asset to protect asset. Yes, exactly. You're sacrificing a small profit in case that low probability event doesn't happen, because most of the time it won't happen, right? Because it's a low probability event, right? So most of the time you will lose that profit, but for those 1 out of 10 times or 2 out of 10 times, whatever, times where that low probability event does happen, you will have recouped those missed out profits or reduced profits by a long shot, right? May I ask why I enter 2 positions instead of setting 2 trigger orders at the decisive move? I'm not sure that's the same thing, no? You would enter a long and a short down here. That's the idea. So that's when you want to open a position, but also want to protect your asset in case that low probability event does happen. So as an example, here on Bitcoin, there we go. I had a short running, or had a short open here, in case we did break this. We wicked down, and I closed around break even here. So in case Bitcoin would have just continued to dump, any loss from my long here would have been compensated, but instead I sacrificed some profit to protect my asset. Would both position sizes in hedging be the same? Yes, because you want them to doesn't have to be the exact same, but you want them to sort of compensate for one another, so they have to be of similar size. Otherwise, your hedge won't compensate for your failed trade, for example. So yeah, you want them to be comparable in size. Like say a trigger order at where your 2 positions would have stop loss. Trigger order where your 2 positions would have stop loss, you break even until stop. Yeah, but like I'll try to show this. So when you're hedging, you're not trying to benefit off both sides. You're trying to benefit of one side, but in case a small probability event happens, you are protected. So if you enter a short here, like I did, to protect my asset, my plan isn't for this to dump. My plan is for Bitcoin to go up. right? So the second this dump here has been invalidated, I'm going to close my short. Okay. So that's sort of the example on how to. I'm going to switch my song because this is tragic. 1 sec. Clear queue. There we go. So you can move stop break even sooner? Yes. So the idea here is that if you're looking for a new position, say you're looking for a position and a low probability event could happen, so I'm going to hedge against that, and the second that a low probability event is ruled out, you can close that hedge. That's the idea. It's for a big account. It's for any account size. Account size makes no difference at all. So that's how you can hedge against opening a position. But sometimes you're already sitting in positions, right? Sometimes you're sitting in positions. And you want to, let's go on an example here. Let's do algo as an example. We are currently already sitting in this algo position. And I want to hedge. Let's say we're back here. There we go. We're currently sitting here. We are currently sitting at resistance, right? Of this major zone here. Right? We're currently sitting at resistance. So potentially doing a hedge short in case price dumps from here could be an idea to sort of recover any lost profits from us moving down, right? Because the reason you wouldn't want to TP instead, because that seems like it would do the same thing. The reason you wouldn't just TP is because when you TP, you sacrifice your good entry, right? This was a massively good entry. So if you were to TP up here, you would have sacrificed that good entry. You would have lost that good entry. But if you hedge instead, you can keep that good entry while still making money if we reject here, right? So let's make an example for this, right? So let's say we are currently over here, up. I'll try to draw this. Plus $10,000 currently sitting in profits at this area, okay? That's what we're currently sitting on once we reach this on our long here, this area. If we were to go down here, we would be, instead of being up 10,000, we would be up, say, 8,000. Okay? So you've essentially lost 2,000 in... You wouldn't have lost anything, but 2,000 of your profits have been removed, essentially. So you're essentially minus 2,000. So what you can do instead is to open a short here, which will benefit exactly 2,000 if it reaches this area here. Because then you're still up 10,000 and you didn't have to TP here from your initial position. Right? So from this short here, let's say I'm going to move this over. Let's say I'm going to do like that. Move that over like that. Let's say price does decide to dump. You have now benefited. I'm going to move this over so it's correct. There we go. You have now benefited off this move down, or you profited another $2,000. So yes, you could have just TP'd 2,000 from this profit here. But if you did TP 2,000 from this resistance here, you would have reduced, in this case that would be a fifth of the position, you would have sacrificed a fifth of the position at this entry price here. So you have missed out on a lot of good potential profits if price continues to go up because you have such a good entry price. Right? So not only does it protect your assets, it also protects your good entries. Does that make sense to you guys? I'm going to go through examples here. Sorry, questions. So for an example, your Bitcoin trade still has a third DCA open, so it like that could be an idea, yeah. Just right. You close a short position in this case as soon as the short is valid. Yes. No, I don't let it ride to stop loss. That would be dumb. And most of my hedges don't have a stop loss. As soon as the the improbable event that I'm hedging against, as soon as that's ruled out, I'm going to close my hedge. Sometimes price action moves down to take out the long stops liquidations and go up to take a short. To protect against this, look at liquidity levels and order book. I'm right. So in cases where price just fluctuates extremely up and down, in those cases, I tend to hedge. So let's just take an example. I'll do an example of that after I've answered those questions. Hey man, do you have any tips on how to compound a small account? How does one minimize their losses and maximize profits? There is no difference with a big or small account. Only difference is getting filled. That's all the difference. So you would treat it the exact same way as a higher portfolio. How do you position the hedge with fib retracement? No, you position the hedge by looking at places at key levels, basically. At places where the probability of price moving up and down isn't 50-50. Essentially at key levels. Because in those cases, it's not 50-50. So yeah, I'll talk about the example that Super said. So let's just say we have Bitcoin as an example. We have an example all the way back here of this crazy thing that happened here. That's basically, I believe that's what he or she is talking about with this. In case we have something like this where we can stall it for a brief period and then boom, liquidate shorts and boom, liquidate longs and then go back. The way you would hedge against this is, say we have a key level up here, right? This is your key level. Okay, and let's say you were long here. You were originally long. You don't want to sacrifice this good entry here by TPing up here. TPing at this key level. So instead, you would enter a short off this key level here. Let's say this was a resistance to recoup any missed out profits by us moving back down. This would be huge. And when your original long that you hedge with, the second that goes break even, you close it. So this would now be closed. So this would be zero profits. Okay. So this would be break even. So you can actually essentially move that. This would go down all the way to the next key level. Let's say the next key level is down here. Instead of sacrificing this amazing entry here, this is an amazing entry. You caught the top, right? Instead of TPing, you would enter a long hedge. Boom. In case price does retrace. And what happens? It does. So you recoup any missed out on profits by prices going back up. So this would, your essential short profit will be up here. And your long profit will be that. So you would essentially have the exact same profit as if you were to TP your full position down here. But the difference is that you have saved and you have kept this good entry. That's the idea. So be smart to also create a small shorts at each TP level, as the TP levels are essentially at resistance. Not at like small levels. It has to be a very, 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 very key level, right? So it would have to be a very, very significant level. Not going to be just a micro resistance. It has to be a huge resistance. So yeah, or huge support, huge key level essentially. When we need to hedge on every trade or something else, I hedge on almost every trade. So close to trade break even. Could you set stop loss to break even if the market is choppy? Sure. That's essentially what we did here. We went up. So instead of us sacrificing, So because we want to keep this entry, that's why we entered this short hedge. But once we break even, we can enter again. So there's no point in keeping this entry, right? Because it's not as good of an entry anymore because we're literally sitting at that entry price. So moving stop loss break even, sure. Does that make sense? Because one of our goals is to sort of preserve our good entry. But if we are already at that good entry, there's no point in preserving it, right? You can just enter another position, right? So in those cases, you can do stop loss break even. But I hope that made some sense. So this is what it looks like. Professional trader. It's like going Super Saiyan. So like May 22nd levels and all-time levels on Bitcoin. May 22nd. May 22nd. Where's that? That's on here. I'm not sure what you mean. Is there a limit to how many hedges you should do for position? Not really. I mean, also for position, I usually stick to around 1 to 2 hedges per position. So yeah. So yeah, that's sort of the simplest way to enter a hedge. You enter a hedge off key levels in case that low probability event that you see can happen does happen. Okay. 1 sec here. I'm just gonna trim a position here I have running. Real IRL trading here. Going nicely. Okay, I'll go back to any questions we may have regarding this. Look at that snap entry. Holy. Someone is typing. I'll wait for them to finish their question and then we'll move on. This guy writing up a Bible or something. This is taking a while. So yeah, that's sort of the super basics of hedging on. Gotta go. Thanks for seeing. No worries, man. That's sort of the super basics of hedging with just standard futures, right? We'll get into more hedging with spot and also touch on options as well, briefly, shortly. But I'll just wait for this person to finish the question and then we will then we'll talk about it. Is it likely you hedge this Bitcoin trade? At what levels are key resistance to Bitcoin short? So, for example, up at the 70k level would be, for example, an area, right? Around here. To potentially enter a small short in case we dump again, right? But if we do flip this, you would close that short, right? So you would sacrifice some brief profits, but on the bigger picture, you would have saved yourself if it went back down. And also save this potentially good entry in case we go down and go back up, right, off this key level. So you can TP your hedge there, for example. Could you show me the name for the VWAP indicator, please? It's just a standard VWAP indicator. It's a standard one. Go to indicator, search for volume, weighted, average price. Select that one. Go to the settings. Choose the yearly. Turn on all the multiple bands, and that's it. That's the VWAP for you. It's a standard one. I wish I'd known this or thought of this. By the way, I had lost sizable amounts. That's unfortunate, but now you know. So yeah, that's sort of the super basics with hedging with futures. The second way, which is somewhat more popular, is that considering a lot of exchanges don't allow you to open a short and a long at the same time on coins, or sorry, on perpetual contracts. What a lot of people do is they say they're in a massive short, right? Let's just go on. What's the coin that is dumped? Let me think. Question maybe. Oops. Say here. Say we're currently sitting back here, right? You're currently sitting in a short from this top, okay? And instead of TPing at, say, this key level here, instead of taking profit there, which would remove your good, or sort of reduce your good entry here, what a lot of people do is they buy up some spot. Okay, they buy spot, in this case ocean, they buy spot ocean at these levels here. So in case price increases, their spot position will have made money, while your short has been reducing its profit. So you haven't lost any money on this, so you're actually profiting both ways, so it's actually double profit essentially. And if price continues to dump, you would, considering it is spot, you could continue that hedge, right? Where you buy up more key levels there and there and there, etc. Right? But you could also just sell your spot if your hedge is invalid, essentially. It's no different to the future thing. You just have to put in more position size. That's all, and you don't have to worry about liquidations and things like that. I'm just gonna go ahead and take a screenshot of this. One sec, guys. 1 second. Yeah, that Bitcoin long is up 50% right now, so I'm just gonna close this real quick, if that's fine. Go. Percent. I'm just gonna post this in my channel too, and then I'll get to any questions that may have been asked since I went away from the chat. There we go. Okay, let's see. Chat. Okay, no questions. That's good. I hope that means it made sense. Also, and as you can see here, we went up from this key level, for example. So, for example, your spot from down here would have saved some reduced profits from your short, right? That's the idea. Go. Can you do short, long, same exchange? On some exchanges you can, on some you can't. Just sort of depends on your exchange. On most exchanges, it won't allow you to do a short and a long at the same time on the same coin in the same 24 hours. But you can wait a few days and then probably do it. But I hedge almost exclusively using options, and I'll get into that briefly as well. So yeah. So options. I go back to Bitcoin. So say here then, you were in a long, like I'm currently in, and you wanted to hedge off this, right? Once price reaches this area, you can do a few things. Actually, before that also happens, you can do a few things. From this position we're currently in, I'll just do that with an arrow. And if we're currently up here. Okay, so if you're down here, what you want to do is hedge off the low likelihood that we continue, right? Because that's the low likelihood, because this is resistance, right? So you want to hedge off that low likelihood. So what you can do, you can buy some call options. In this case, this price is 70,000. So you'd buy call options expiring, say, a week or a month or something like that, to then, because you would buy call options with a strike price of 70,000, and the second price hits 75,000, these would go in the money, and you would make tons of money on that. Once an option goes in the money, the option value goes sort of skyrockets, right? So you would pay a small premium to get the option, and once this does get hit, you would you would sell that option at a higher price, and then based off those profits, you would enter a short, right? So I'll try to do this as an example here, to a bit more typed out, so you guys can sort of understand this a bit better. So say here at this current price, buys 70k calls for, let's say, a premium of 0.113. Let's say, so it's 0.113 Bitcoin. That's a premium you're paying for the option. That means that currently the option contract is worth 0.113 Bitcoin, around that will be around 7,000. So once you go up here, these would then go in the money, and say they're now worth 0.17, right? 0.17. You then sell them, and you will profit the difference here, which is so profit is first you pay minus 0.113 for the option, and then you sell it for 0.70 plus 0.70. So your overall profit is 57. So 0.057. 0.57. So you've essentially made an extra 0.05 Bitcoin, essentially. So you made around 3,000. Okay? Or sorry, 3,500. Something like that. Okay? And based off those profits you've just made, you can then enter a short here to hedge against the high likelihood that we do go down without sacrificing this good entry. So enter short, and then say close the hedge at the key level, which will be down there. And if it continues to go up, aka invalidates this low likelihood event, you would actually not lose any money off this hedge, considering you just made 0.05 Bitcoin off that hedge up to here. Right? So in this case, you would, even though you were wrong, you would have actually made money. That's sort of the beauty with hedging with options. I can do a more in-depth thing with this later, but yeah. Where do you buy option calls from? So I trade options on a platform called Deribit. I'll type that. Deribit. But I have all my long-term options through a partnership I have with Paradigm. But so this is where I have my long-term hedges, and this is where I do my trading. So you can hedge on Deribit just fine. What's the worst and best case scenario for hedging? So the worst case scenario in this case that would happen is you're currently sitting in long here, and instead of your calls that you bought here going in the money by price increasing up there, they would go down. Say this happens. In this case, your long would have been break even. So let's say you close at break even, and you would have lost that premium you paid. You would have been minus 0.1 Bitcoin. That's the worst case scenario. Yeah, that's the worst case. Because any other scenario, you would be in profit because your calls would have been in the money here. You would have sold them, and then that would cover any losses from your hedge, right? So that's the worst case. You would lose that premium you paid for the option, which is, in the grand scheme of things, based off your portfolio size, it's not going to be a huge amount. That's the beauty with options. You can pay relatively low amounts, yet profit big amounts. That's the idea. because you essentially have exposure to leverage. But yeah, that's the idea with hedging. But this is like a bit more complex, so you can just stick to the standard hedging we talked about earlier, where you hedge the futures and spot potentially. So you can stick with that just fine. So that's sort of the best case would be you selling your options up here as they go in the money, and price continuing to go up to fill your TP on that original long, and that for the fact that you sold your option, that would cover any losses from your hedge. That's the best case, and you would profit huge amounts. So you're sort of defining and limiting your risk, yet increasing how much money you can make, considering you did buy these calls down here, right? That would give you an extra element of profit. That's the idea. Someone writing in a question, I suppose. Two people actually typing. So I'm gonna go through some of these while I wait for you guys to finish. How do you confirm an SR flip before you enter position? Sometimes I feel like I see a confirmation, but it's not. So generally, you want to see several, say, 30-minute or 50-minute closes above. So the main like thing you want to look for. Let's say you have this SR here. You need to see consolidation above, on whichever time frame you do the SR, right? So this is on the 1 minute. You want to see 1 minute consolidation. If you do this on the 4 hour, you want to see some 4 hour consolidation, right? So let's say you have this. You want to see consolidation and then the retest. That would sort of confirm the flip. If you only see stuff like that, it can very well just be a fake out, an SFP. So yeah, that would not be a valid SR flip. You want to see consolidation above. That's the main thing we look for. Consolidation above. Buy the call at 70k for the premium. Okay. If you were to buy the call at 70k for the premium of 0.113, it would make the premium fee be 9k, and once it reaches, let's say, a strike price of 75k, would it be break even at 70k or 75k? So options are quite complex. It's not, even though, let's say you bought, and I'll just go on a different BTC chart here to sort of have it a bit clean. Okay, this wasn't any better. Okay, I'll just use this one. Say you bought a 70k call option here, right here at this point of time. You bought a 70k call option for, say, 70k call 70k call at 0.113. Say that. You bought a call at 70k. Okay. Even though if price were to go up and down and be at the same exact price level, your 70k call option will not be worth the same amount, even though the price of Bitcoin is the same. Okay. So it's impossible to say that if it goes back to 70k, it's going to be break even, because option prices derive from more things than just the asset price. Okay, this is what makes options, 1, more complex, and 2, better than standard derivatives. Okay, so even though we are sitting at the exact same price level there and there, and here, this call option may be worth, instead of 0.0113, it might be 0.01. So it has actually lost value. Or in case implied volatility has been going up, it might be at 0.20. So you've actually made money on the option, even though price is the exact same as it was previously. That's what's so beautiful with options. You can make money even if you can essentially make money if price goes against you. So yeah, I've been trying to figure them out, and there aren't very good YouTube videos on it. No, there isn't. There's almost no good YouTube videos on it. I can do a super quick explanation of this. It's not going to be super relevant to hedging, but I'm sure a lot of you guys are curious to know what options are. So options are essentially contracts that allow you to buy a specific amount of shares or quantity of an asset at a specific price. Let's do AMD, for example, a stock, because it's slightly easier because they have numbers of shares. Okay. So let's say currently AMD is sitting at 209. Let's say you buy a call option with a strike price of 230. So right here you buy I'll just do this with triangle. You buy a call option, AMD at 230 call at, let's say you pay 0.15. And in stocks, you don't have to think too much about this. The premium is essentially times 100, so you would pay $150 for each contract. But this is the idea. You pay $150 for the option, and if AMD were to go up to your 230, you would then have the right. Actually, let's say it goes up to 240 or 250. You would then have the right to buy 100 shares of AMD at 230. And then, so you would buy at 230, so you'd buy them here. Just do that with a line. You'd buy 100 shares of AMD at 230. I'll make these green and big. You'd buy there, and then you can sell them up here at 250. Okay, which means that you will have made a $20 profit per share. So times 100, that's 2,000. You've made a $2,000 profit, and you only paid $150. Right? That's what's so good. You pay a very, very low amount, but it gives you exposure to massive profits. So that's what's called exercising the option. It's when you buy 100 shares of the asset and then sell it again. That's what exercising means. You use your option, because an option gives you the right, but not the obligation, but the right to buy 100 shares of the stock. Is the strike price when you can exercise the option? Yes. For calls, if the stock price is at or higher than the strike price, you can exercise. And for calls, so for puts, if you're buying a put, you're betting on price going down. For a put, you can exercise the option if it's at or below your strike price. So in this case, you have extracted, you bought at 230 here, 230 per share, so 100 times $230 times $230 equals $2,300. So you pay $2,300, and then instantly, because you do all of that buying and selling up here. This is just when it went in the money. So let's just make it actually up here, and make the strike price a regular black line. There we go, 230. There we go. You then buy 100 shares of AMD at 230, and then sell them instantly at 250. 100 times $250 equals $2,500. Okay. So you've made now $200. So profit equals $200. And this was off a, I don't know how big move this was. This was off a 10% move. Okay, so with a very small portfolio of $150, because that's all you need to buy this option, because the premium was 0.15, you have essentially over double your investment by a quite insignificant price movement, right? So you actually have around 10x leverage on this option here. Okay, but so this profit you can extract from the option by exercising it, this 200, that's called intrinsic value. Okay, so say here, let's just take another example here, which is going to be a bit more easier. Let's remove these. Actually, move them. Oops. Let's move them down. Say instead you bought a call option at the current market price. So with the strike price of the current market price, so 208. So AMD 208 call at, let's say you paid 0.18. That's what you paid for the option, for the call option. So $180 minus $180. That's what you pay for the option. Okay. So this is what you paid for the option. Let's say the price goes up to 240, say. You can then exercise that option and make the difference, which in this case will be $302. Because 240 and 208, that's going to be $32. So $320 in profit. Why is 180 0.18? That's just how the option premium is written, because it gives you the right to buy 100 shares. So this is just the price per share. And 100 times 0.18 is 180. I'm going to make this correct here. Okay, so that's incorrect. 1.8, sorry. My mistake, guys. There we go. That's going to be more correct. So like I was saying, you paid 180 for this contract, and it goes up to 240. So now, let's say your same call option is now worth, instead of being 1.8, let's say it's now worth say 3.6. Okay, aka $360. 360. Like we talked about earlier, you can exercise the option as soon as it goes in the money. So in this case, you could have bought at 208 and sold at 240. Well, actually, let's do this at 560 actually, because it's more. Let's say your option is now worth 5.6 or $560. You would have actually made let's say you then bought at 208 and sold at 240, because that's what the option allows you to do. You would have made $320. But that $320 that you can make from the exercising the option is less than what the option cost. In fact, it's $240 less. So for some reason, this 240 here, this comes from somewhere. Okay, so we'll just have this on the side. You paid 180 for the option, and you can sell at 560. But if you exercise the option, you can only make 320 instead of 560. This means that for some reason, $240 of value that has been given to the option, that has to come from someplace, right? This is where we differentiate from intrinsic and extrinsic value. Intrinsic value, I'll do this, so there and there. Intrinsic value, which is going to be this. Intrinsic value. That's going to come from any value you can extract from the option by exercising. Okay? So that's going to be the difference between the market price and strike price. So the difference between 240 and 208, that's going to be 32. So $320. That's going to be your intrinsic value. But we also have $240 that we haven't accounted for. Okay? So where does this $240 come from? It comes from two main things. One, theta, and two, IV. So I'll type this out. Theta, time decay. This is time decay. And also IV, implied volatility. Time decay essentially represents, so an option loses value all the time. An option you bought a year ago, even though today, let's say a year ago you bought an option at $100. Today, even though the stock price may be the exact same, that option may be worth $50 instead of $100. The reason is for time decay. And the reason why we have time decay is because, or the reason option becomes less and less valuable the more time that goes, is because sorry, I forgot to put this as well. All options have expiry dates. So let's say this expires in a year. So the 8th of March 2025. You can only exercise that option until the 8th of March 2025. And if 8th of March 2025 comes, your option that was worth 5.6 is going to be worth 0. Because of time decay. Because the more time, the closer you get to expiration, the less time your option will have to get in the money. AKA, the less time it will have to reach your strike price. Okay? That's why time decay exists. It's because the more time you have, the more time your option has to go in the money. And the less time you have, the less time your option has to go in the money. So a part of this 240 comes from the fact that there is still some time until your option expires. That's some value added to the option. The second part, implied volatility. There's also high implied volatility means people expect the price of the asset to be very, very volatile in the future. Okay? And the reason high implied volatility gives it a high value is because if you have a very, very volatile market, the chance of you going in the money, so let's say price instead of being at here, let's say it was down here, the chance of you going in the money, aka going up to 208, is far higher if the volatility is high, because it's going to go like this, rather than if the volatility is low. That's why value is attributed to an option if it's expected to be volatile. So that's where this comes from. That's where this extra value that comes from, and this is called extrinsic value. Extrinsic value. So value given to the option purely because of intrinsic value and theta or time decay, not because of the value you can give. The value you can get from the option by exercising. And this is why I said earlier that with the hedging, where we talked about buying a 70k call, and once they want in the money, you would make a lot of money. That's why, and we said that option prices skyrocket. It's because of this intrinsic value. The second an option goes in the money, it gives the option intrinsic value because it can be exercised, right? Before if it's out of the money, so it hasn't reached or went above the strike price, there is no intrinsic value because it cannot be exercised. So then you only have to pay 240. Okay, so that's why I said that you want to bet on the option going in the money, because then you would be given intrinsic value. So your option price, what you can sell the option for would skyrocket because it had just been given intrinsic value. That's why out of the money options, so options that haven't reached the strike price, are far cheaper because they have no intrinsic value. And if they go in the money, you make a shit ton of money. but they are risky because for in the money options, like we talked about earlier, when your option reaches the expiry date, it's worth 0. Okay. But if you have an in the money option, let's say it's priced around here, so it's in the money, you can exercise your option. Okay. And therefore your option wouldn't be worth 0 because you could still use that right to buy. And the only thing that you would lose by exercising the option would be the premium you pay. So you would only lose $180. But if you held on to the option without exercising, you would lose all of that. All of this setup. So that's the idea. So I'll try to sort of bring everything together here. Options give you the right, but not the obligation, to buy or sell if you have a put 100 shares, or in this case AMD, at a specific strike price before a specific date. Okay. So yeah. Do calls also have a liquidation point? No. Calls don't have a liquidation point. You can never lose. When you have a call option, you can never lose more than you paid. In this case, you can never lose more than $180. That's what's so good. You're exposed to leverage, like you are currently when you're trading Bitcoin and stuff like that. But when you're trading Bitcoin with leverage, you can lose, in theory, an infinite amount. But with options, you're also exposed to leverage, but you have a limited amount that you can lose. You can only lose 180, but your profit is uncapped. That's what's so good about options. That's why I trade options a lot. It's because I can limit my risk, but I can have leverage. I can still have leverage. So no, options don't have a liquidation point because they always go down to 0, nothing less. So you'd be more profitable if you're able to exercise way before your expiration date. Yes, correct. Or no, sorry, not the time you exercise your option means nothing, because when you exercise your option, you lose all of this extrinsic value. Okay. So when you, let's say, buy at 208 and sell 240, you will have lost this extra 240 that your option is worth, because the reason this extrinsic value exists is because, well, time until expiration and how volatile people think the price will be in the future. But if you exercise the option, there is no time until expiration because you have just removed the option. You've just used the option, so there is no time until expiration, and the option doesn't have any implied volatility because, again, you have just used the option. So when you exercise an option, you will lose all of this, no matter the date. So you can exercise 100 days before or 1 day before, and it will make no difference on your profit, as long as the stock price is the same. But if you were to sell the option at 560, selling at 560, so let's say 100 days before expiration, rather than waiting 50 days, this 560 may have been going down to 400 because the time until expiration has decreased. I know, like, I did this I started in the middle of options, and I didn't really introduce them too well, so I'm sorry about that, but I hope this has made some sense. If you have any questions regarding this, I can answer you. But yeah, I introduced this in a sort of a poor way, but that's fine. So yeah, if you have any questions regarding this, please ask. So I'll take an example here of a current option. So I'll go on Nasdaq options chain. 1 second. I'll go and find this exact call option on let's say Tesla. Do you recommend we include options as a stable in trading? They seem kind of good in terms of risk versus upside. Yes, I do. I trade options a lot. and it's a very, very big part of my edge. So I'll take a screenshot of an option here. We'll go to Tesla, because I'm going to do an option from Tesla. I'm just sitting at 175. So we'll screenshot this here. Oops. May. Let's do May, and then screenshot the 181. There we go. So here we go. Here I pasted the options chain. This shows you everything you need to know about the option. So what we're mainly focused on is this. This is the strike price, and this is the price of the option per share, basically. Okay. So this means, so I'll zoom out here and move this over so I can try to show this in a bit better way. This means that with a strike price of 180, a option expiring on May 17th cost $1,449. That's what you pay if you were to buy it right now. So this is your strike price, 180. Let's find it. There we go. Okay. And this is the current market price. There we go. So you pay 1,449 minus 1,449. So now we can try to see the difference between your strike price of 180 and the current market price. So 180 minus 175.5, that's 4.5. And that again times 100, because it's 100 shares, is $450. $450. So off this 1449, 450 of that is the intrinsic value. My bad. There we go. So 450 of this option, or the price of this option, comes from shit. That was a bad example because it's not in the money. Let's do a different one. My bad. All of this 450 comes from intrinsic value. All of this 1449 comes from intrinsic value. Because again, it's not in the money, so therefore it can't be exercised. So I'll pick an option that's in the money. Let's do 160. We have this 160 here. Let's do that one instead. There we go. So I'll screenshot that and put it in. There we go. This we can see has a strike price of 160. And currently, and if we were to buy right now, it costs 2,558. 2,580, I believe. Yep. And then, there we go. That's what you pay. Strike price is 160. This means that you can exercise it right now. So now we'll look at the difference between the market price and the strike price. In this case, it's around 15.5. That means that around 1,550 of this 25.8. I'll do this in premiums terms, so it would be 15.5 and 25.8. Around 15.5 of this option price's value comes from the simple fact that you can exercise this right now and make, in this case, $1,550 just by buying right now and selling right now. Again, exercising the option. But there's a remaining 10.8, sorry, 10.3. 10.3 that hasn't been accounted for. This comes down to IV and theta, like we talked about earlier. Okay. What does in the money mean? In the money means that for calls, if you're in the money, your strike price is below or at the current market price. For puts, it's above. It means that you can, if you're in the money, you can exercise your option, aka you can buy 100 shares of the share of the stock. Sorry. So yeah. But yeah, this was sort of a tangent that I didn't really want to go on, but it is what it is. So yeah, I'll head out now. I'm gonna go watch a basketball game. So yeah, I'll see you guys later. Thanks for coming through, and I hope you guys benefited from the hedging part of this at least. I apologize for the rambling on everything else. So
we should do a stream on options for you. We should. It's a vast topic, but I believe the way you explain it, very few will be able to.
Good to. Alright, we can probably do a stream on that later. But yeah, I'll talk to you guys later and see you.
Take care of yourself, man. Pleasure as always.